There's a question so simple it sounds almost naive. And yet no economist on a major network, no central bank governor in a marble-floored press conference, no finance minister standing before a parliament has ever answered it cleanly. Every country on Earth carries debt. The United States owes more than $33 trillion. Japan's debt exceeds the size of its entire economy by more than double. France, the United Kingdom, Italy, Canada, Brazil, all of them running deficits, all of them borrowing, all of them paying interest to someone. And that word, someone, is where the story begins. Because if every nation on Earth is the borrower, then somewhere, behind the architecture of bond markets and central bank balance sheets and quietly worded financial treaties, there is a creditor. There's always been a creditor. And the creditor, in every civilization that has ever borrowed its way through history, has held a power that no army, no election, and no constitution has ever fully contained. To understand who holds that power today, you have to go back. Not to a textbook, not to an economics lecture. You have to go back to a moment in history when the modern financial world was still being built, when the rules that governed sovereign debt were not yet rules at all, but decisions made by specific men in specific rooms for reasons that had nothing to do with the public good and everything to do with the oldest dynamic in human civilization. The relationship between the one who needs money and the one who has it. The year is 1803. Europe is on fire. Napoleon Bonaparte, first consul of the French Republic and soon to be its emperor, is preparing to reorder the continent by force. Britain, his greatest rival, is mobilizing its navy and its treasury. The Austrian Empire, the Prussian state, the Russian Tsar, all of them are calculating the cost of the coming war, and all of them are arriving at the same terrifying conclusion. The cost is more than any of them can pay from their own revenues alone. War, as it has always been, is a financial problem before it is a military one. Armies need wages, cannons need iron, supply lines need grain. And all of that needs money. More money and faster than any tax system in the early 19th century could possibly generate. Into this world and into this need stepped a family that had spent the previous 3 decades building something that no one had quite built before. Not a bank in the traditional sense, not a trading house. Something more fluid, more invisible, and ultimately more powerful than either. The House of Rothschild, operating simultaneously out of Frankfurt, London, Paris, Vienna, and Naples, had constructed the first true international financial network in European history. And in a continent about to tear itself apart over 20 years of war, that network was not merely useful, it was indispensable. What made the Rothschilds extraordinary was not simply that they had money, though they did in quantities that dwarfed most monarchies. What made them extraordinary was that they had speed and discretion in equal measure. In an age when a message from London to Vienna took days by courier, the Rothschild family had built a private intelligence and communications network, writers, agents, coded correspondence, that moved faster than any government dispatch. They knew the price of grain in Amsterdam before the Dutch government did. They knew the outcome of Waterloo before the London Stock Exchange did. And they used that knowledge not recklessly, but with the patience of men who understood that the real profit was never in a single transaction. It was in becoming necessary. Nathan Mayer Rothschild, stationed in London, became the financial architect of Britain's war effort against Napoleon. He moved gold across a blockaded continent through networks of agents and intermediaries so complex that neither the French nor the British government fully understood how it was done. He raised capital for the British Crown on terms that would have been impossible through any conventional channel. He was not a general, he held no title, he commanded no troops. But without the financial infrastructure he built and operated, Wellington's army in the Iberian Peninsula could not have been supplied, and the coalition that finally brought Napoleon down might never have held together long enough to do so. And here is where the story turns, and where it begins to say something about the nature of financial power that has never really changed. Because Nathan Rothschild was not financing Britain out of patriotism, and the Rothschild network was not financing Napoleon's enemies out of ideology. The House of Rothschild, across its 5 European offices, was doing something that sounds almost incomprehensible until you understand the logic of sovereign lending at scale. It was, at various points and through various instruments, providing financial services to multiple sides of the same conflict. Not simultaneously, not always directly, but Across the arc of the Napoleonic Wars, the Rothschild network touched the finances of Britain, of France, of Austria, of Prussia, the full cast of the conflict. Because the family had understood something that kings and emperors, blinded by nationalism and military ambition, could never quite see. The war was not the point. The debt was the point, and the debt would outlast the war by decades. When the guns finally fell silent after Waterloo in 1815, the map of Europe had been redrawn. Empires had expanded and contracted. Dynasties had trembled. Napoleon was on his way to a rock in the South Atlantic. And the governments of Europe, victors and defeated alike, were buried under the financial obligations they had accumulated to fight each other. Britain's national debt had reached levels that would not be surpassed for nearly 2 centuries. Austria was financially exhausted. Prussia was borrowing to rebuild. France, now under Bourbon restoration, needed credit simply to function as a state. And the institution best positioned to provide that credit, to restructure those obligations, to float the bonds that would let European civilization limp forward into the 19th century, was the same family that had financed the war in the first place. This is not a conspiracy. It requires no shadowy meeting or secret handshake to explain. It is simply the logical consequence of what happens when private financial capacity outgrows public financial capacity. When the resources available to a single creditor exceed the liquidity available to sovereign states. In that condition, the creditor does not need political power in any formal sense. The creditor simply needs to be present when the borrower runs out of options. And in post-Napoleonic Europe, the borrowers always ran out of options eventually. The Rothschild model established something that would echo through every subsequent century of global finance. It established that the most durable form of power is not the power to wage war. It is the power to finance one, and to hold the debt afterward. It established that sovereignty, the idea that a nation governs itself according to its own interests and decisions, is always partially theoretical when that nation depends on external credit to survive. And it established a pattern that would replay itself across the Ottoman Empire, across Latin America, across the colonized territories of Africa and Asia, and eventually across the entire post-war global order in ways that would make the Rothschild operation look modest by comparison. To understand how that pattern evolved, you need to travel east and south from the drawing rooms of Vienna and London to an empire that is often described as the sick man of Europe but is almost never described accurately for what it actually was in financial terms. The Ottoman Empire, at its height in the 16th century, was one of the most powerful political entities on Earth. It controlled the eastern Mediterranean, the trade routes between Europe and Asia, and a tax base that stretched from the gates of Vienna to the Persian Gulf. It had survived for centuries on the strength of military conquest and agricultural revenue, and it had done so largely without the apparatus of modern sovereign debt, because for most of its history it had not needed to borrow in the way that European states were beginning to borrow. That began to change in the mid-19th century, and it changed with a speed that no one inside the Ottoman system was prepared for. The Crimean War of the 1850s, in which the Ottomans fought alongside Britain and France against Russia, was the moment the empire crossed a threshold from which it never returned. The war was expensive in ways that overwhelmed the empire's traditional revenue systems. And so, for the first time in its history, the Ottoman government went to the European capital markets and borrowed. The first loan came from British and French banks in 1854. It was followed by another, and another. And over the next 2 decades, the Ottoman government borrowed so repeatedly and on such unfavorable terms, and used so much of that borrowed capital, not for productive investment, but for military expenditure and the servicing of previous loans, that by 1875 it was spending more than half of its entire state budget on debt service alone. In 1875, the Ottoman government did what over-leveraged borrowers throughout history have always eventually done. It defaulted. It announced that it could no longer meet its obligations to its European creditors, and the response from those creditors was not forgiveness, not renegotiation in any meaningful sense, and certainly not patience. The response was the creation in 1881 of an institution called the Ottoman Public Debt Administration, a body staffed and controlled by representatives of the European creditor nations, given direct authority over the collection of Ottoman tax revenues, and empowered to redirect those revenues toward debt repayment before the Ottoman government could spend them on anything else. Read that slowly because it matters. The Ottoman Empire, a sovereign state with a 6th century history, an army of hundreds of thousands, a territory spanning 3 continents, surrendered control of its own tax collection to a foreign financial administration because it could not pay its debts. The creditors had not invaded. They had not fired a shot. They had simply lent money on terms the empire could not sustain, waited for the inevitable, and then institutionalized their control in the language of financial administration rather than military occupation. It was colonialism conducted through a balance sheet, and it was devastatingly effective. The Ottoman case is not an isolated historical footnote. It is a template. Across the same decades, Egypt borrowed heavily from European banks to finance the construction of the Suez Canal and the modernization of its agricultural infrastructure. When Egypt defaulted on its debt in the early 1880s, Britain used the financial crisis as the justification for a military intervention that resulted in a British occupation lasting 70 years. In Tunisia, French creditors used a debt default as the pretext for the establishment of a French protectorate. In Latin America, British and later American financial interests used the leverage of sovereign debt to shape the economic policies, the trade arrangements, and in some cases the governments of nations that were nominally independent but financially captive. The pattern is consistent enough across continents and centuries that it begins to feel less like coincidence and more like a method. Extend credit to a sovereign borrower, ideally during a moment of stress, a war, a modernization project, a fiscal crisis. Allow the debt to compound on terms that gradually become unsustainable. Wait for the default. Then use the default as the mechanism through which the creditor acquires control, not of territory in the old imperial sense, but of revenue streams, trade arrangements, monetary policy, and economic governance. The flag stays. The sovereignty is renegotiated. Now consider what happened after the Second World War, because the post-war financial order was not designed randomly. It was designed. In July of 1944, as the war in Europe was still grinding toward its conclusion, representatives of 44 Allied nations gathered at a resort hotel in Bretton Woods, New Hampshire, to construct the financial architecture of the world that was going to emerge from the wreckage. The decisions made in that hotel over 3 weeks would shape the movement of money, the terms of sovereign borrowing, and the nature of financial power for the rest of the 20th century and beyond. The Bretton Woods system created 2 institutions that still exist today, the International Monetary Fund and the World Bank, and it established the US dollar as the world's reserve currency, anchored initially to gold, and then, after 1971, to nothing but the credibility of the American state and the productive capacity of the American economy. What it also created, less visibly, was a new architecture for the management of sovereign debt crises, one that placed enormous power in the hands of the institutions that controlled access to international credit. The IMF, in its formal mandate, exists to provide emergency liquidity to nations experiencing balance of payments crises. In practice, what the IMF does is function as the creditor of last resort for governments that have exhausted every other option. And when a government has exhausted every other option and needs the IMF's money, it does not receive that money without conditions. Those conditions, structural adjustment programs they were called from the 1980s onward, typically required the borrowing government to cut public spending, privatize state-owned enterprises, liberalize trade, reduce subsidies, and restructure its economy according to a set of prescriptions written in Washington. The governments of Ghana, Argentina, Mexico, Indonesia, Greece, and dozens of others applied for IMF assistance at various points across the late 20th and early 21st centuries. Each of them, in accepting the money, accepted conditions that constrained their economic sovereignty in ways that their own parliaments and electorates had not voted for and could not easily reverse. This is not an accusation. The IMF is not a villain in any simple sense. Lending requires terms, and terms require accountability, and governments that have borrowed beyond their capacity to repay cannot always be trusted to make the adjustments necessary without external discipline. But the deeper question, the question that the Rothschild story and the Ottoman story and the Egyptian story all point toward, is about the nature of the power relationship that is encoded into sovereign debt itself. When the creditor can set the conditions under which the borrower must operate, The creditor's power exceeds any power formally granted by treaty or constitution. It operates in the register of necessity. You do not have to agree with the creditor's terms, you simply have to need the money. And who in the modern world are the creditors? The answer is more distributed than in the 19th century, but no less concentrated in its ultimate effect. The largest holders of U.S. Treasury debt, the instrument through which the American government borrows, include Japan, China, the United Kingdom, and various sovereign wealth funds operating on behalf of oil-producing states. The bond markets of the developed world are underwritten by a combination of institutional investors, pension funds, insurance companies, asset management firms, whose combined assets under management reach into the hundreds of trillions of dollars. Firms like BlackRock, Vanguard, and State Street collectively manage more capital than the GDP of most nations on Earth. They are not governments. They hold no elected mandate. They answer to their shareholders and their clients. And the sovereign debt of virtually every government on Earth passes through their systems. When a government needs to borrow, and all of them do continuously, it issues bonds, which are promises to pay back borrowed money with interest. Those bonds are bought by the market. The market sets the price. The price determines the interest rate the government must pay. And if the market decides, for whatever reason, that a government's debt is becoming too risky, the price falls, the interest rate rises, and the government finds itself paying more to borrow, which typically makes its fiscal position worse, which makes the market more nervous, which drives the price lower still. This is the feedback loop that destroyed the Greek economy in 2010 and 2011, that forced Italy to install a technocratic government acceptable to European bond markets in the same period, that has quietly disciplined the fiscal choices of governments across the developed world for decades. No bond trader issued a command. No creditor sent an ultimatum. The mechanism is automatic, embedded in the architecture of the system itself. Governments that displease the bond market, through excessive spending, through monetary experimentation, through policies that creditors find destabilizing, face rising borrowing costs that function as a veto on those policies. The British government discovered this with particular violence in September of 2022, when a budget that proposed unfunded tax cuts triggered a collapse in gilt markets so severe that the Bank of England had to intervene to prevent pension funds from failing. The government that had drafted the budget resigned within weeks. The bond market had spoken, and it required no vote. There is a phrase that entered financial journalism in the early 1990s, coined by a political strategist working for the Clinton campaign, who observed that the bond market had become so powerful that in any future political contest, he would want to be reincarnated as the bond market, because then you could intimidate everybody. The phrase became famous precisely because it captured something that most political discourse refuses to say plainly. The most consequential constraint on what any elected government can actually do is not the opposition party, not the courts, not public opinion. It is the willingness of creditors to continue lending at affordable rates. And so we return to the question that opened this story, the question that sounds naive until you begin to trace its answer through 8 centuries of sovereign debt and civilizational consequence. If every country is in debt, who is the creditor? The answer is not a single family, not a single institution, and not a single nation. The answer is a system, a set of arrangements, incentives, and instruments that evolved over centuries from the private banking networks of medieval Italy, through the bond markets of Amsterdam and London, through the Bretton Woods institutions and the post-war dollar order, into the vast and largely invisible architecture of global capital that now intermediates between every government on Earth and the money it needs to function. The creditor is not a person. The creditor is a structure. And the structure does not need to be conspiratorial to be powerful. It needs only to be necessary. What history suggests, across every iteration of this story, is that the structure is most dangerous not when it is obviously predatory, but when it is genuinely useful. The Rothschilds did not merely extract wealth from the governments they financed. They also stabilized post-Napoleonic Europe, facilitated the spread of railroads across a continent, and provided liquidity to governments that would have faced fiscal crisis without them. The IMF has prevented disorderly defaults that would have caused humanitarian catastrophe in countries whose governments had made genuinely reckless decisions. The bond market does impose discipline on governments that would otherwise spend far beyond their means. The creditor in every era has offered something real, and in offering something real has made the relationship of dependency that much harder to escape. The civilizations that have navigated this relationship most successfully are not the ones that refuse to borrow. Virtually no modern state has operated without sovereign debt for any sustained period. The ones that navigated it most successfully are the ones that borrowed with clarity about what they were doing, that understood debt not as free money but as a claim on future sovereignty, that maintained enough productive capacity and institutional strength to service their obligations without surrendering their ability to govern themselves. And the ones that collapsed under it are the ones that borrowed faster than they could grow, that used debt to substitute for governance rather than to enable it, and that woke up one day to find that the terms of their financial survival had been written by someone else. The world's largest economies are, right now, borrowing at a pace and a scale that has no real historical precedent outside of wartime. The United States is adding more than $1 trillion to its national debt every few months. Japan has monetized its debt to a degree that has effectively merged its central bank with its treasury. The European Union is navigating sovereign debt dynamics that nearly destroyed the euro once already, and remain unresolved beneath the surface of apparent stability. And the global bond market, the creditor sitting behind all of it, is watching, as it always has, with the patience of an institution that does not need to rush. Because the debt does not go anywhere, it compounds. And the moment of reckoning, when it comes, is never a surprise to the creditor. It is only ever a surprise to the borrower. History has already run this experiment, many times. In Rome and in Constantinople, in Madrid and in Istanbul, in Buenos Aires and in Athens. The names change, the currencies change, the institutions through which the credit flows change with each century. But the fundamental geometry of the relationship, the creditor's patience against the borrower's need, the slow accumulation of obligation against the finite capacity of any civilization to service it, that geometry has never changed. It is older than capitalism. It is older than democracy. It may be older than the state itself. The question is not whether the system you live inside was designed before you were born. It was. The question is whether the civilization you inhabit has learned anything from the ones that came before it. History, unfortunately, suggests that the answer to that question is almost always the same, and the creditor is counting on it.